Good morning, Fundamentals of Investing students. This is Mr. Fritsch, and this is your unit materials for the week of April 27th through May 1st. Once again, you'll have notes, an assignment, and a test, which will be open notes. I'll add this video to the top of the list as well. So, for the notes that you're going to need to do the assignment and the test, we're doing fundamental analysis. It's the cornerstone of investing. If you're going to invest in stocks, you need to understand fundamental analysis. All right? It's a combination of quantitative and qualitative analysis that we're going to get into right now. All right, one of the biggest parts of fundamental analysis is using financial statements of publicly traded companies. So what you're going to do is we're going to get more into quantitative and qualitative analysis in just a minute, but quantitative analysis is when you're going to use numbers, measurable things, to decide whether or not a company's intrinsic value, which is what you think it's really worth, is greater than or less than the market value of the stock, whatever it's trading at in the marketplace. All right, and then there's also qualitative analysis, which are more subjective, which are unquantifiable, which are things such as company's management, their business model, their competitive advantages, things that you can't really measure in actual numbers. All right, so let's scroll down a little bit. The very basics you can go through by yourself. Once again, quantitative and qualitative. Quantitative, capable of being measured or expressed in numeric terms. Qualitative, related to or based on quality or character of something. All right, we're going to give you examples of both right now. So, for quantitative, this is things that you can measure. They're numbers. Company earnings, you're going to have a dollar amount. Amount of inventory, once again, a dollar amount. Amount of dividends, a number. Company sales, number. All these things are just numbers that you can use to analyze a company. All right? As opposed to qualitative, which are less tangible factors, more subjective, such as who's on the board of directors, who are their CEOs, CFOs, CEOs, who are their top executives, what is their brand name recognition, what kind of business model do they have, do they have patents or technology above others, do they have a competitive advantage? All right, so once again, you're looking to find a company's intrinsic value, which is what you think the company's stock price should be worth, and what it's trading for in the market, or the market value of that stock at any given time. All right, there are two major assumptions. The first major assumption I have in two parts. All right, so the first major assumption is that investors can locate stocks that have a market price less than that of the intrinsic value, and you'll be able to make money by buying those undervalued stocks. Or you can find stocks that have a market value greater than its intrinsic value, and you'll be able to make money by short selling those overvalued stocks. All right, so once again, you're comparing intrinsic value, what you think the company's really worth, or what the stock price is really worth, and the market value of what it's really trading at. The second major assumption of fundamental analysis is that in the long run, the stock market will reflect the fundamentals, meaning that a stock that's trading below its intrinsic value will finally come up to its intrinsic value, and a company that's trading at a higher price than its intrinsic value will come back down to its intrinsic value at some point in the long run. All right, but the two big unknowns are, one, is your estimate of intrinsic value accurate? And two, how long will it take for the intrinsic value to be reflected in the marketplace? All right, so you're going to find undervalued and overvalued companies based on what you think the intrinsic value is. And then the second part is how long will it take for the numbers to come and jive with one another. All right, qualitative factors, I go into more detail here. I'll let you do that on your own. Reasons that a company might have a competitive advantage. I've listed 7. There are more than this, but these are some of the big ones. All right, a competitive advantage is when you have an advantage over your competition. You might have it because you have superior natural resources. You might have political contacts, or you might have some type of patent technology or something that your other competitors don't have. All right. Once again, you're going to go through and just look at these different qualitative factors on your own. All right, and then we come to quantitative analysis in specifics. Once again, these are things that you're going to measure in numbers. One, the balance sheet. It's a financial statement that shows you assets and liabilities of a company. All right, assets are things that you own that have value. Liabilities are things that you owe to others that have value. So if you subtract liabilities from assets, that's what your company's worth. The second financial statement under quantitative analysis is your income statement. It shows your revenues, which is all the sales that all the dollars coming in, your expenses, which are all the dollars going out, spending on things like salary expense, rent expense, buying your products and services that you are going to resell. All right, so those are your expenses. When you take your expenses away from your revenues, you're left with profit. All right, and then I go into details on how you can use these financial statements, specifically the income statement, in order to find out what a company's intrinsic value is, hopefully different than its market value. All right, next, when a company wants to cut costs, one thing they can do is integrate vertically. They can buy the companies that are below them, or they can buy the companies that are above them. All right, and that way your expenses are going to be lower, and you should be able to make more money. I'll let you go through the definition on your own. All right, and then I have the last section of this unit is financial ratios. This is when you take numbers and you compare them to one another. There's two major financial ratios that I want you to know for quantitative analysis. One is the price to earnings ratio, which is the PE ratio, which all you do is you take the stock price, what it's trading at in the market, and you divide it by the annual earnings per share. And then you can use this number to compare different companies in the same industries to see which ones have high PE ratios and which ones have low PE ratios. All right, and then the last one is, or the second ratio is price to book ratio. And it compares the price per share to the company's book value. What's a book value? Book value refers to the total amount a company would be worth if it liquidated all of its assets and paid back all of its liabilities. So basically the book value is if you take all your assets, you turn it into cash, and then you pay off all your liabilities. What's the company worth? That's the book value. All right? So once again, those are the notes you're going to use in order to take care of finishing up the assignment and the open notes test. The assignment's due by Wednesday at midnight, and the test is due on Friday, May 1st by midnight. You may do them both tomorrow if you wish, or today, which would be Monday. If you have any questions, I'll be online all week, office hours from 8:30 until 2:30 in the afternoon, 5 days a week, and I'll also be checking emails at night. Okay? All right, I hope everyone stays healthy and safe, and enjoy.